Let's get some insights in the news shaping the markets. For that, we welcome in David Doyle's with us, head of economics at Macquarie. Thank you for being here. Fed Day tomorrow. I know everybody's going to be listening to the language. We've had inflation showing, right? CPI, PPI. But there are folks who say to me they should do a cut now because things are turning. I mean, what do you say?
Look, I would disagree with that take. I think it would be premature to declare victory on the inflation front, especially after the past couple of months. My sense is that the Fed will give it a bit more time before they start their rate cutting cycle. We're not expecting a rate cut until July, which means there's going to be a couple more meetings here where we're waiting for them to take action. And so, but we'll see what happens with the release tomorrow. I think a lot of attention will be on the dot plot and what they're signaling through there, as well as Chair Powell's press conference.
Yeah, and when you say July, then you start to say, well, how many cuts, right? Will it be one and done? Probably less likely. Are you expecting a few by the end of the year?
So we're looking for just two cuts of 25 basis points each, so a total of 50 basis points by the end of this year. We suspect they'll go in July and then, wait until December before proceeding again. And part of that is driven by our economic view that growth is likely to remain resilient. And in that context, there's not going to be, at least in our senses, there's not going to be an urgency to be cutting rates with unemployment relatively stable, growth relatively stable. And so as a consequence, the Fed will have, I think, some luxury of waiting to make sure that they've done their job on inflation before lowering rates further. So again, we see the first cut in July and then a second cut in December of this year.
Yeah, so there'll be a few pauses in between. They're getting good at those pauses, and that will be after the election's done as well, and that may be part of it too. We're going to be hearing more from New York Community Bank. We've had some volatility in the markets, whether it's some of these regional banks or some of the tech names pulling back. I mean, Bitcoin surged, then pulled back. How are you feeling about the market overall?
Well, I mean, I think with the market action over the past few months, I think has largely reflected the economic data and sort of a more upbeat tone that you've seen, especially from several of the leading indicators. I note there that you had single-family housing starts up strongly this morning, which might be contributing to an improved tone there. But sort of overall, it's been that the leading indicators have gone from potentially indicating that a downturn was ahead to suggesting, things are looking relatively okay. And I think the market has largely responded to that. It's remarkable to me that the market has been so strong, even in the context of a reduced expectation for rate cuts. And that to me is a reflection of the economic resilience that we're seeing. The one thing I would say that makes me nervous when it comes to the market action is just that it does feel like most people now, at least from whom I'm talking to, are pretty optimistic and fairly bullish. And that's the one thing that makes me cautious in the sense that, typically maybe the pendulum has swung too far one way. But at least in this case, there is some justification for the gains that we've seen so far this year, in our view, when we look at that economic data.
Yeah, there is that feeling where more and more people are feeling a little bullish, and that can be, and you look at investor sentiment and such, and that really can be the contrarian indicator, right? Sometimes I've heard smart money, right, saying, we're pulling out and taking some profits on NVIDIA and things like that, and Bitcoin. I had a guest who came on and said, I'm pulling out of NVIDIA, pulling out of Bitcoin. And probably glad he did, because both of those went down recently. In the big picture, what about the labor market and the consumer?
Yeah, so I think the labor market has proven to be resilient. You've seen pretty steady non-farm payroll gains so far this year. The one concerning aspect of the labor market has been that the household survey, which is the second survey that the BLS conducts as part of that monthly employment report, has shown some weakness. So on its own, that's a bit of a red flag for us. But you're not seeing much weakness elsewhere in the labor data. So for example, initial unemployment insurance claims, continuing claims, both remain relatively subdued. And again, as I mentioned, non-farm payrolls continue to show strong growth. So I think in aggregate, the labor market is showing resiliency. And that gives us confidence that the consumer, can remain, I would say resilient as well. As long as there's jobs growth, as long as there's not a significant spike in unemployment, I think consumer spending can maintain steady growth. Maybe not as strong as what we saw in 2023, but certainly a steady growth seems possible. And the one thing I'd comment on the consumer that's shifted over the past several months is that we've moved from being in a regime of negative real wage growth into a regime of positive real wage growth. So the pace of wage growth now exceeds the pace of inflation. So there is a fundamental positive that can fuel steady spending gains.
Yeah. And last but not least, I know you don't recommend stocks per se, but Macquarie takes a look at sectors. You have a high rate environment, a cut or two are coming. And you said there's been somewhat of an upbeat tone. What would you say to investors? Do you like certain sectors? These seem to be the safer places to put money, or, how are you positioning it here?
Yeah, look, I would just look at sort of the broad equity market and say, if we're right and if the economic expansion has further room to run, then you're probably looking at further gains in the broad market. We don't try and weigh in too strongly on sector positioning. What I would say is one area where I think you could see relative strength over the next year is the housing sector, especially the single family housing, which is beat up and low as a share of GDP. I think that's one area where you could see disproportionate strength. So gaining exposure to that in some way through the equity market might be a good idea here. But generally, I think that as long as the economic expansion looks set to persist, the broad equities should make further gains.
All right. Thank you, David Doyle of Macquarie. Good to see you. Good insights there into the big picture and the Fed day tomorrow, folks.